Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
You're listening to Bloomberg Intelligence Radio. I'm Alix Steele alongside Paul Sweeney. We cover all the top news for you with our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries worldwide. And we're going to do that now with one of them in relation to Apple. So that stock is down over 1%. It's a tough tape for sure. But the news overnight was that Apple has assembled about $14 billion worth of iPhones in India in the last fiscal year. So we want to get perspective with Anurag Rana. He's Bloomberg Intelligence senior technology analyst. He's the guy we go to for all these kind of headlines. Anurag, always a pleasure. $14 billion worth of phones sounds like a lot. Is it?
No, it's not a whole lot.
Okay.
But at the end of the day, one of the things we have seen that over the last 2.5, 3 years, Apple has been assembling its phone outside. And, for us, the real reason for that is a couple of years ago, there was a COVID big issue in China. It had an impact on some of the phones coming out that had an impact on sales and so forth. Now, having said that, that was one reason. Second, Apple, prior to the, you could say the COVID issue, was completely dependent on China for all the assembly and their parts. Now, what we are seeing is they are moving out of the assembly from China into other areas, mostly India. But one of the things I tell everybody at the same time, they still make most of the parts. So it's, if we ever get into a problem with China in terms of geopolitical issues, we still need those parts to assemble the phone. It's not as if, those parts are available all over the world.
Anurag, I just wonder how, investors in Apple view this China risk. Are they of the opinion, I assume that if they own stock in the company, they have some level of comfort with the China risk here. Do they just believe it's, hey, it's kind of a mutually beneficial relationship, Apple and China, that at the end of the day, that's what's going to keep everything moving?
So, Paul, I've seen two different buckets. One is people are extremely concerned about the U.S.-China relationship in the long run. They obviously have, they don't want to deal with Apple or any other companies that, fall into that bucket. But the other side, listen, this is part and parcel of the global world chain, supply chains, and most manufacturing companies are dependent on China, like it or not. They seem to be okay with it. From our side, yes, absolutely the biggest risk that Apple faces from a stock point of view, from a revenue point of view, from a supply chain point of view, is if something happens between the U.S. and China. And we've talked about that quite a bit. But from a sales point of view, I think it is, to me, that's a bigger issue right now in the medium term, because China accounts for 18 to 20% of total of Apple's sale. And frankly speaking, that is the big growth engine. And we have seen over the last 12 months problems in that growth engine because of Huawei.
How much do they make these phones for in India versus China versus other areas? I'm trying to get a sense of where the margins are and what they look like.
That's a very good question. And frankly speaking, we thought when they started making more phones in China in India, or we started see new phones coming out of that would have an impact on their gross margins. But they have managed it very well. And remember one of these things, it's the factories that they outsource their stuff to. It's kind of somebody else's headache. But in the end, Apple will have to make some, you could say, concessions. But at the same time, so far, we have not seen any impact on Apple's gross margins. I mean, surprisingly, we have seen them, hold up very nicely over the last 2 years.
Can you just kind of characterize the competitive landscape for Apple in China vis-a-vis Huawei and other phones here? Are they maintaining share, losing share, gaining share? How's Apple doing?
So Apple has not done the same number of sales as Huawei over the last 12 months. Now, there are two elements of it. One is the competitive landscape. People are choosing Chinese phones over a foreign brand. So that's one aspect. The second aspect, which I'm hoping is probably, correct in the long run for Apple's sake, is that Huawei didn't have a very, brand new phone for several years. And this is their first big new refresh, which is why people who have been using Huawei phones in the past are going out and refreshing their phone at a much faster clip. So that could be the second reason. Apple doesn't have that same, I would say, the cachet is still there, but typically what I would do is if I have an Apple phone, I'm doing everything on it, chat and the pictures and but in China, what happens is you do a whole lot of your transactions using the apps that you have or the super apps. And for that, you can download those apps in any ecosystem. So I would say on a comparative basis, you are less prone to be an Apple customer than you are in the Western world.
Well, that's interesting. So then to that point, is that what the regulation or the penalties in the EU and the US is going to force Apple to do in essence? So it won't become that enclosed ecosystem in the same way?
Well, there is no super app in the US that is very much like WeChat. I mean, you could say WhatsApp could be one of them, but frankly speaking, I mean, Apple's done such a good job of, I would say maintaining their customer base in the US and in Europe that, I mean, I don't see that happening, that suddenly a new app comes in and people start using that over what's going on with Apple or the habits that they have right now.
All right, Anurag, I've got the iPhone 11. Do I upgrade now? Do I wait? What am I doing here?
You should wait till the September, October, framework, because one of the things is, as we talked about it last week, if in June they are able to go out and convince the world that they do have an AI play with new features coming in, then you would need a little bit more firepower in terms of the memory and the CPU. Which means the next phone will have a faster version of that. I would wait for that because you will have both bigger memory as well as faster speeds.
Interesting. See, that's what they get you, right? Like once you start, you can't leave that enclosed ecosystem.
Oh, totally.
It's definitely a thing.
Yeah, it's absolutely.
So what's the next catalyst now for Apple? What are you looking at? Well, any catalyst, I guess, would be a better way of
June.
asking.
I mean, it's June's Worldwide Developers Conference where they are supposed to talk about AI and what's Apple's AI strategy. That is the only thing that can actually put some fire in this particular, where is it down 13-14% year to date? Because other than that, I mean, we don't see China bouncing back this year. We don't see any major new product announcement, and obviously Apple Vision Pro is not going to drive the overall growth rate of the company. So it's the iPhone, and if there is anything that's out there that can force Paul to go out and buy a new phone, I think that's going to drive the next cycle.
All right, well, I'm heading down to Duke tomorrow, Anurag, so there's a reasonable chance I might bump into Tim Cook. I'm going to make my dividend increase pitch yet again.
And he's going to run away from you.
Probably.
Yeah. Is that how that conversation goes?
That
You say it,
goes.
he's like, leave me alone, Paul.
Yeah, I said, would it kill you to put a 2.5 or 3% dividend yield on this thing? All right, Anurag, thanks so much for joining us. Anurag Rana, Senior Technology Analyst, Bloomberg Intelligence, from the technology growth boomtown of Chicago, Illinois. Go figure that. So yeah, we'll see. The Apple, I think if you're a shareholder, you have to be I'll take the China risk. I think the bigger risk isn't necessarily supply chain, but the competitive risk and the risk to my sales that people, for whatever reason, are we're not really buying American stuff if we don't have to.
Well, yeah, and also it disrupts the thesis that like all of India is going to go buy an iPhone, which is like all of China is going to go buy an iPhone. Like clearly we're seeing a difference in that thesis too. So it's such a good point. Not a supply chain issue with China, but just straight up demand.
Yeah, I think that could be the bigger issue.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm interested to see we are breaching those technical levels for the markets, but then what winds up happening to buying the dip? Does that materialize, or do we actually get a proper longer sell-off? Frances Donald is a global chief economist and strategist for Manulife Investment Management, and she joins us now. Great person to talk to on this. Do you think investors buy the dip on this?
Oh, I'm not sure I'm there just yet, Alex. I mean, we've been living in soft landing euphoria where everything is perfect. Growth is coming in just fine, but inflation is declining. And we've said you can't have your cake and eat it too. Either growth will hold in too long, inflation will reaccelerate, and you will lose your rate cuts, which is what's happening. Or, and I think this is the next phase of this, growth will deteriorate and you will no longer be in this soft landing narrative. So we still have concerns that even though inflation is coming in sticky, growth is going to decline in the second half of the year. So what worries me is this word stagflationary is probably going to come back a lot more in our narrative in the next 3 to 6 months. That's a very difficult place for the Federal Reserve to be. They're going to have to pick their favorite child, Sophie's choice. Is it inflation or is it growth? And I think it's a really difficult environment for risk assets. They're going to have to deal with the worst of both worlds.
Oof, it's no bueno. So how about the Federal Reserve? If I'm Fed Chairman Jay Powell, in the back of my mind, do I have a scenario where I don't cut rates at all this year?
Of course, that's always a scenario. I mean, the team and I sat down this morning. Our base case has been the Fed would go later but faster, but we'd penciled in June as a starting point. And so I said, team, are we moving to September? And all of us agreed we got to wait in the next 24 hours. There is so much Fed speak coming forward. And I think you know as well as I do, it's not uncommon to see extra Fed speak pop up when you have big moves of this magnitude. Mm-hmm. So what we want to know is not the data itself, but what is going to be the interpretation of the data. There were many categories in today's CPI that are not going to flow through as strong to PCE. Right. Does Chair Powell want to emphasize that? What about that wages are decelerating fairly rapidly and all of our leading indicators of wages say, well, there's not going to be a wage price spiral. If the Fed wants to cut in June, they have enough data to be able to say, hey, we're going to cut in June. If they like to take the opening the bond market gave them to go later, then you'll probably hear a lot less from them in the next 24 hours. They'll try to stay mute. But this is this part in the cycle where macro forecasting and Fed forecasting becomes a little less science and a little more art. It's a lot more subjective. I need to hear what Powell says, not just what the data looks like.
And just talking about sort of market reaction, euro dollar is down as much as 1%. We're now at 1.07, biggest drop since July. So we'll just watch out for more of those superlatives as we go. You mentioned the PCE CPI thingamabob, and I say thingamabob because like not everything counts in the same weight in the different baskets. But you had the firmer motor vehicle insurance cost and medical care, and both of those are what feeds into PCE differently. So why, how, what does the Fed talk about with that?
Whatever they want. And this is what's been really challenging for us is there are measures like 6-month annualized CPI ex shelter heading into this was sub 2%. That was totally enough for the Fed to be cutting, or they can lean on the shelter side of the picture. So this is a really challenging environment where the Fed can choose what numbers it wants to focus on. They can tailor which data they reference to what they think is the appropriate outcome. We're talking a lot about inflation here, but let's not forget the job side of the picture. The job side of the picture, when you look at the leading indicators, is weakening. And there on then, they can say headline job growth is good, or they can say full-time jobs have been deteriorating very sharply, and that suggests there's going to be labor market weakness. That's why listening to the Fed is going to become paramount. And unfortunately, especially for those of us that are trying to actively trade it, a lot more volatility in rates in the next couple months.
All right, well, if the underlying jobs data maybe is not as strong as the headline data, and we have persistent inflation here, it's got to be tough on the consumer out there. How do you think about the U.S. consumer?
Depends which consumer you are. I know there's a lot of depends coming through here, and it's because we have so much diversification and desynchronization. This is a really big term. I mean, this week we had a horrible small business optimism number. It was more like small business deep pessimism number that's very consistent with dark recession. And yet CEO confidence is off the charts. Look at consumer confidence by income. High income consumers are feeling gosh darn good, and low income consumers are struggling. They're out of excess savings. Their credit cards are too expensive. They're going delinquent. If you're a high income consumer, you're a saver, you're benefiting from investment returns and house prices returns, you're in really good shape. Let's not forget those high income consumers, the top 20%, they spend 35% of all expenditures. So if you're a consumer right now that is interest rate sensitive, you are feeling recessionary. If you are not interest rate sensitive, then things look really pretty for you. The key here is not to cherry pick which side of this you're going to look at. It's to understand from a policy perspective that the economic experience across income groups and regions in the US is very different. Yeah. And from an aggregate perspective, to look top down and say, what does this look like in totality, not just looking at one side of the picture or the other.
So, and to that point, sort of just looking at the areas where we saw increases versus decreases, I found to be so interesting. Not to like bore you guys, but things like car insurance and clothing and personal care and education and furniture. That all went up, right? But what went down are things like the price of butter, for example. Grocery store foods went down. Cereals and bakery products, so like gourmet croissants. So like it's hard. So I wonder, are we in like a rolling inflation scenario where we kind of saw that last year and the year before when it comes to rolling recession in certain areas of the equity market and the and industries? Are we in that place right now?
Possibly. I mean, on the flip side, goods are actually in straight up deflation right now. So where we're seeing the inflationary pressure is on the services side. But we were a little bit worried today when we were going through the number. We said, look, apparel is starting to pick up. There's enough categories that the momentum is moving in the wrong way. So that's causing a little bit of concern for us. One thing I can't help but think about is last year, my team and I were saying constantly, hey, when the Fed cuts rates, you won't be asking why. And yet in December, when Chair Powell pivoted, I constantly was asking myself, why? What changed from October to December to really create this movement? It didn't seem like a good idea. And there's going to be criticism on Chair Powell, I think today, especially that he pivoted too early. He eased indirectly and therefore inflated the economy a little bit too early. I think that's going to be some of the pressure he gets. Now, on the flip side, if they say, okay, you know what, we're going to push out rate cut expectations to later this year, you might see some of that inflation come back. It is a veritable roller coaster. For our clients, we tell them, focus on the 2-year horizon. 2 years from now, rates will be much lower than where they are now. Whether they start in June, September, or frankly, 2025 is less relevant for most investors than that 2-year cycle. So that's what we're advocating, focusing on not big bets right now, not super tactical bets right now, unless, of course, you have to.
I like that 2-year view. Makes sense to me. That being said, we do have the warp function on the Bloomberg terminal where people are kind of pricing it out month to month here. So are you guys in the camp that says, hey, this Fed doesn't have to rush, they can wait as long as they want?
Well, we're very bearish on the economy compared to consensus. We still have a recession in our forecast. And actually, today's inflation print, which tells us the Fed is going to stay a little bit longer, amplifies our concerns about recession risk for later this year and into 2025. So we see 2025 as being really underpriced when it comes to easing. But for the rest of this year, as I said, we're going to listen to the Fed a little bit in the next 24 hours. It's going to be June or September. Of course, we're going to have a lot of short-term focus on that. But big market moves should really be driven off of, are we heading into a recession? Is it a traditional easing cycle with hundreds of basis points of cuts? That's going to be far more important for asset allocation decisions for bonds and stocks than June or September.
Francis Donald, thanks a lot. Manulife Senior Chief Economist and Strategist over there. Yeah, and that's so interesting too, because when you take a look at what the forecast is, does it matter why they cut? Like, are they cutting because the economy stinks, or are they cutting because they're normalizing? And if they're normalizing, that's not going to be like 300 basis points of cuts unless the economy super tanks. Right. So does that change how you allocate?
Yeah, exactly right. And I think what a lot of folks took from today's data is, in any scenario, you could make a stronger case today that they can wait a little bit.
Yeah. Why aren't we talking about hikes?
Why aren't we talking about hikes? Right. Yeah. That's no fun, though.
No, it's no fun, and we don't like doing it. But like, why aren't we actually talking about it at that point?
Yeah, exactly.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
I should point out the S&P is off the lows of the session. Just down 0.8%. I feel like my buying the dip question isn't as crazy as maybe we would have thought 2 hours ago. So let's ask it now to Shana Sissel, President and CEO of Banríon Capital Management. She joins us now on Zoom from Chicago, Illinois. Shana, do you buy the dip?
I always buy the dip.
Oh.
Okay, but
I mean, the market goes up more than it goes down. Why wouldn't you buy the dip? It's not like the market's going to go permanently down. I'm a big fan of buying on weakness, and there's weakness today for good reason. Also, I feel the need to tell you, I heard your earlier comments about Funko, and I had to have my bobblehead in the shot for that reason.
Oh, so is that a Funko bobblehead?
It is. It is.
Is that your head?
I had to do it. That is supposed to be my head.
All right, we're going on the
I don't
website.
know how accurate it looks, but that's supposed to be my head. But I digress. No, I'm a big fan of buying on weakness. We have strong economic growth. CPI coming in hotter than expected is an indication of that. We still have very strong demand. I think the market's weak, obviously, on the fact that this makes a Fed rate cut less likely. But I've been saying all along that I thought the 6 that was originally priced in earlier this year was a pipe dream. Thought it would be more like 3. Now I'm actually going to go really far out on a limb here and say I don't think they're cutting this year.
Torsten Slok over at Apollo Management agrees with you. He was out with a note this morning reaffirming that call for him. Shana, So when you think about your portfolio, think about the stocks that you like out there, how much do you worry about Federal Reserve policy, about the interest rate environment vis-a-vis the fundamentals of those companies?
I think it affects some of the growthier names more than it affects, say, a name like Fang, which is on my list. That's an energy name. I think that's more a supply-demand situation. I think the demand for oil in particular isn't going anywhere anytime soon. But for the growthier names, Fed policy can really impact, the valuations and the potential upside because of just how time value of money works. Higher rates tend not to be helpful for growth names because you got to have more growth. And so, you can't get as much of a premium as when rates are really lower. But I don't worry about it too much because I think the overall tailwinds are so compelling that even in a higher rate environment, higher rates mean the economy is doing well, which will mean that stocks should do well.
And Fang is Diamondback Energy. Just to break that down, that stock trades about $205.85. So you mentioned that maybe the Fed won't cut at all. Does that pare back the amount of cuts you expect overall in this cutting cycle? Because that would also dictate kind of how the economy is doing.
Yeah, so I think that the Fed has a target interest rate. So I think they'll cut as much as they have to get to what that target is. I think it's probably somewhere between 2 to 3.5. It's not zero. I know we got used to zero, but it ain't zero. And so I think we'll get there. If they have to do it faster and there's less cuts, that means that we've had some sort of economic instability. That's how I look at it. If there's more cuts, that means that we've achieved the unicorn soft landing, which I'm still not convinced of. So I don't have an opinion on that. I just think that more cuts means smoother landing, right? That stupid thing when you fly, smooth landing, Air Force pilot. Yeah. So we've achieved a smooth landing. The Air Force is in control. And if they have to cut fast and they're bigger cuts, it's because there's some sort of economic stability and they have to hit the deck really hard.
All right. So a name like NVIDIA, which is a name we've talked about with you before, you guys own that. I can't think of a interest rate scenario that would get me off of that story because I mean the fundamental drivers of AI, if you really believe the growth potential of AI, that is got to be a building block story in that. So how does the movement in today's market kind of impact your thoughts about a big growth story like NVIDIA?
Well, you and me both. I don't think the Fed has any impact on NVIDIA because of the AI trend. We're so early on there. It's trading at like a 28 times forward earning multiple, which is insane to me. I still look at like just the sheer price of it at over $850 per share. And that's intimidating because my cost basis on it is $250. But not to brag or anything. I don't own that much. I don't own that much and I haven't added to it. That just sounded really obnoxious. But yeah, so I'm not sure I'm necessarily a buyer, but I do find the 28 times forward earnings compelling. So maybe I jump in here, especially on weakness like today. Mm-hmm. If it got under, say, 825, I would be jumping in all day long.
You also own Vertex Pharmaceuticals, ticker VRTX. It's a biotech company. Tell us more.
So that's a super volatile company. Biotech is not for the faint of heart. But I like some of these healthcare names right here. Some of the more volatile ones, actually, because drug development is always volatile. You might think you have something great, and then you get to, the stage 3 trials, and all of a sudden everything falls apart. Vertex has some great cystic fibrosis drugs. The stock has been super volatile, but volatile to the upside. So you get some really crazy movement in the stock, but the stock has positive returns. I think they have kind of a dominant position in cystic fibrosis, which is a major concern. That's a major disease that affects a lot of people, and those things are positive for the stock. They have some great R&D, and those are the things that I think are the key drivers. It's good management, smart balance sheet, all the things you look for in a good stock. But it is biotech, so it is not for the faint of heart.
Biotech, not for the faint of heart. NVIDIA, one could argue, not for the faint of heart. How do you guys screen for stocks at your shop. I mean, do you tend to go for growth? How do you screen?
So oddly enough, my entire background and all the years I've been in the business has been value. I know that seems strange looking at like my recommendations here. But I don't screen the way that you would normally hear. I started my career in manager research, and so I used to meet with managers of funds, hedge funds, mutual funds, ETFs all the time, and they talk about their stocks, right? So I got a lot of my ideas from them. So I've met with thousands of managers at this point in my career, and there are like a handful that I think are amazing. And those handful are the ones that I will look at their portfolios. I'll look at their 13Fs and see what they own, maybe pick up the phone and ask them, and find out their reasoning. And then I'll do my own work on the stock, see, does it make sense to me? Is this story something that I think is compelling? But that's how we get my ideas. I don't screen for stocks like most folks who sit there and pick, 20, 30, 40 stocks because they have to manage a portfolio. At any given time, I might be following 10 names because that's not the core of our business, but that's kind of how I get my ideas.
Gotcha. All right, Shana, thank you so much for joining us. Really appreciate that. Shana Sissel, President and CEO of Banríon Capital Management.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's check in with one of our favorite economists. We like to talk about macro stuff with Jeffrey Cleveland. He's the chief economist at Payden Rygel. He's in that little hamlet out west called Los Angeles. Jeffrey, thanks so much for joining us here. Boy, the kind of looking at what's happened in the financial markets here today, I don't think they were discounting this kind of inflation print. What did you make about the CPI?
Well, someone said Uggs earlier, and I just thought ugly. That's all I could think about. Yeah, I mean, so I think, as I always say, context matters for markets. And the context going into this number was that January was a fluke and February was a bump in the road and things were going to settle down. And this morning's number, core CPI in particular, at another 0.4. That tells me it's more than just a fluke. A colleague just texted me and said, what's the technical definition of a trend? And I said, 3 months. 3 months is a trend. And so I think we have a trend here of stickier inflation. And that's what's playing out. And you could say now the 2-year yield maybe is more fairly priced than it was certainly at the start of the year. But we still have a couple of rate cuts priced in. So there might be more room for repricing here still, even after today's number. Yes.
Do you believe that there'll be 2 cuts, or do you think we could be in a situation where we're talking hikes in the next couple months, or are we talking about no cuts?
Last week I said June was off the table. I felt a little nervous about that until we saw this number. So I think June is off. And then I think you have to really wonder about July. And then September is tough for me. I'm not saying the Fed is political. I'm just saying, do you really want to start a cutting or an easing, or to even do just one right before an election? I think, if the data justified it, maybe, but if there's any question mark, you wait. So I think that should really the market should be reducing the probability of that September cut as well. So everything I think is just going to get pushed out. It's possible we only get one, and that would be contingent upon a second half that looks more like last year's second half. Which could happen here. I don't want to get too caught up in the inflation mania at the moment, too emotional about it, but it's entirely possible that we could run the year without getting a cut at this point. I think that's a likely scenario that investors should consider.
Jeffrey, how about just kind of the economic call here, soft landing, no landing? How do you kind of think this economy's behaving right now?
I heard hot landing.
Hot landing?
Yeah, I don't really know what that is, but I heard about that today.
Okay.
So we've been sort of operating with the no landing. It would be an acceleration in GDP, an acceleration in inflation, a new low in the unemployment rate. We're not quite in that scenario yet. Maybe that's more the hot landing scenario. Then we said, okay, sticky inflation. That's where inflation on core CPI hangs out, I don't know, 3 to 4%, somewhere in that range on a year-on-year basis. Good growth, above trend growth. The unemployment rate stays low. So it feels like that's the scenario we're in. We're in the sticky inflation scenario. The soft landing is if you need to see a further moderation in inflation. So at present, we're not in the soft landing scenario, in my view. Now, the one thing I would say, if people are getting too pessimistic about things, I mean, there's a worse scenario, which would be a stagflation type scenario, where we do have this inflation that we're seeing, but growth is struggling. And that is not what we're seeing. The jobs report on Friday, we're still seeing aggregate income growth 6 to 7%. So we're seeing good income growth. That is feeding into spending. That is keeping price pressures. It's not a terrible situation. Good growth, higher than expected inflation. So don't be too bearish about things out there. I'm working for a bond firm here, but I feel like this is advice to the equity investors in some way.
No, we get it. We were talking to Frances Donald of Manulife earlier in the last hour, and she basically, if I summarize, that there is a narrative out there that this is Powell's fault, that he called sort of the pivot in December too early, and that actually reignited the economy and really loosened financial conditions. Is there truth to that?
I don't think so. I want to defend Chair Powell. I think he's done a great job. I'm not being paid for this defense, but he said, hey, we had great progress in the second half of last year. If that progress continues, there's a case that we don't need to be at 5.30 on the funds rate. We can reduce. We don't want to over tighten. That's what he said. He also said we need to see greater confidence. We want to see more data like we've seen in the second half of last year. Well, guess what, everyone? Every investor can look at this. We have not seen more data like we saw in the second half of last year. It's come in hotter. So I think he set it up nicely. The problem is investors. They hear what they want to hear. And I do think a lot of bond investors, it's been a painful couple of years. I get it. They wanted rates to go lower. They wanted cuts. And so there was more hope than it was, actual reading of the economic data in my view. So I don't blame the Fed for this. Investors need to look in the mirror and not find some scapegoat out there in Foggy Bottom in DC.
All right, Jeffrey, thank you so much for joining us. Jeffrey Cleveland, Chief Economist at Payden Rygel, based in LA, joining us via Zoom. In just moments, we're going to be going to former U.S. Treasury Secretary Larry Summers. He'll be sitting down with Bloomberg's David Weston, talk about the CPI print.
Yep. There's some interesting tidbits, though, that you just want to dive into a little bit with the numbers. So apparently, care of invalids and the elderly at home soared 5.9% from February.
Okay.
How does and that's just, you would imagine that's going to get so much worse as the baby boomers age. It's going to be pretty dicey.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So, lots of drama unfolding after that hot CPI. Paul's been bringing it up. The WIRP function, WIRP, that's where you go to see what everyone's sort of thinking about, Wall Street and investors alike, about what the Fed's going to do. And it's currently pricing in about 2 cuts. Man, that is a very different kind of scenario than we saw just a few months ago. Well, let's break it down. Sally Bakewell is Bloomberg U.S. finance team leader, and she joins us now. Sally, as we dig through here, how many reports are in your inbox about pushing a Fed cut back from June to?
Yes, approximately 2,000 of them are in my inbox.
Excellent.
And I think the level of uncertainty remains, but I guess there is this sort of clear expectation of a path to cutting, and around that, Wall Street banks, which will start reporting on Friday, are probably going to have to be rethinking some of the guidance they've given on one of their key sources of revenue, which is net interest income. They had, just a few months ago, warned that they would probably have to see a slide in this metric, but it's looking like they'll be able to up some of the guidance on this now.
Yeah, it's interesting. I'm looking at the reporters in this story on your team here, put in some, showed some of the big banks were providing 2024 guidance, and pretty conservative looking. And I guess it reflected kind of what they were thinking at the time, which is the market's pricing in 6 rate cuts. We have to reflect that in our P&L. Do you think we'll see revised guidance here? Is that some of the issues in the market?
I mean, I think that's what analysts expect. I think investors are also optimistic of that. And the big question seems to be JP Morgan. It is being looked at as one that did have particularly conservative guidance at about 90 billion of net interest income for 2024. And it may have to up that based on the fact that, that was, they brought that out when, they're expecting as many as 6 rate cuts. And now if there are only 2, they'll probably have to revise it. And Wells Fargo is another one being discussed in the same vein. But I think analysts are saying a lot of the big banks, which are sort of more asset sensitive than the regional lenders, could have to rethink their guidance.
But that only holds in a good way if the loan demand is also good, right? I mean, that's the whole idea. Will loan demand be good?
Well, I think as we see banks reporting earnings on Friday, we are expecting to see quite a subdued loan demand because the sort of lagging effect of higher rates is still ongoing. But yes, if interest rates come down, that is in theory a sort of big tailwind for lending because people start to borrow more. And I think it should, in theory, be a sort of positive thing, but there remain uncertainties here that might sort of cloud the kind of expectations that loan demand could come roaring back.
Yeah, I mean, just on Monday, just looking in this article here from Bloomberg, on Monday, JP Morgan Chief Executive Officer Jamie Dimon delivered a warning on the economy. So, he might say to his CFO and investor relations person, say, well, wait. I don't think we need to be taking up our guidance here a little bit because he may have some underlying concerns about the economy.
Exactly. And actually, people are saying that potentially JP Morgan anyway waits till its investor day if it wants to boost its guidance and does it then, and that's in late May. But definitely, I mean, Jamie Dimon, he kind of gave his couched assessment of the economy, which is that consumers remain healthy and they are spending, but there are all kinds of inflationary pressures. There's this very difficult geopolitical backdrop, the transition to sort of a greener economy, ongoing fiscal spending, all these inflationary pressures that actually are a big overhang to sort of, a really robust economy continuing. And that could definitely end up dampening sort of the consumer's ability to borrow.
And that investor day for JP Morgan is May 20th.
All right. Mark your calendars.
Snag an invite. Maybe we should go down.
Yeah. Good idea. Yeah. Take radio down there. Okay. Here's my pet peeve. Marcus, so we all familiar with Marcus? Okay, it's Goldman Sachs' high yield savings account, right? They lowered their rate 10 basis points on Friday. That's not okay. The Fed hasn't done anything. What's going on? And that's my personal way of talking about the deposit beta when it comes to these big banks and then what the Fed's doing.
Right. I mean, I think they continue to be under pressure to stop customers going to other high yielding options. And I suspect that's, what Marcus is doing.
No, they cut it.
Oh, I see.
They cut it 10 basis points.
Okay.
You're not getting paid as much.
You're not
okay,
getting
now
paid.
to be
You're
fair,
not getting paid as much.
Right, it's like 4.6%. They took it to like 4.5 or something like
but
that.
You put it on an account of your size. That's real money.
I mean, we're looking like billions at this point.
Yes.
But still, I mean, but the idea that they're already kind of front running cuts that may not happen till September.
Wow, I mean, that's fascinating.
So what
right?
are the
yeah?
So what are the banks? I mean, as we were talking about before, one of the things is just simply, are they making loans out there? Are they suffering charge-offs? What do we think that we're going to hear from the banks as it relates to credit quality and charge-offs of their loans and things like that? Because I know that's a big metric.
Well, I think charge-offs are expected to be pretty stable, actually. And again, I think that's another sort of signifier, an indication of consumers being in relatively decent health. But of course, they were reliant to a degree on a lot of the savings they amassed during the pandemic. And those, of course, have faded and will continue to fade. So again, the situation with charge-offs seems pretty stable at the moment, but there are those headwinds. And I think also a lot of banks are expected to set aside more money in provisions this quarter than they have done in the previous quarter a year ago, which is another indication that they see sort of storm clouds on the horizon and that people will start to default on their loans and loans will sour and they'll need to be able to cover the cost of those.
We've seen M&A start to pick up, investment banking start to pick up. Is that going to be squashed a bit if we still have higher for longer?
I think this is really interesting. It seems like a lot of the investment community and companies have gotten somewhat used to the current interest rate situation and the current uncertainty, which sounds a little bit paradoxical to say. And for that reason, they have been more willing to do some deals. We've seen a pickup in deals. We've seen IPOs sort of start to slightly rebound. So I think higher for longer hasn't been there's been a persistent deal slump for months and months and months, but investors have started to get used to this sort of uncertain rate path, I think. And so they have been coming out of the woodwork a little bit.
Interesting. Right, because you see the certainty. Well, you're the former investor. You're the recovering investment banker. Yeah. Is it the rate, or is it just the certainty, or the trajectory?
I think it's just the trajectory here. So I mean, I think I think the market's more normalized. We're seeing investment grade market be very robust because they can get deals done, and so they're going to get them done. Could they have gotten them done at a lower rate 2 years ago? Yeah, but that's 2 years ago. Here we are. We need to fund growth. Mm-hmm. So again, just a trajectory of where things are going. So anyway. Sally, thank you so much. We appreciate it. Sally Bakewell, U.S. Finance Team Leader for Bloomberg News. With the article out today from her team, Wall Street banks may redo key profit guidance on fewer rate cuts, i.e. take net interest income forecast a little bit higher.
Yeah, that'd be really interesting to be, and just that even if they don't do it for their earnings season, like recalibrating it, just the commentary on the calls will be quite interesting, and I'm sure that analysts will be all over them to answer that question. So that'll be very interesting indeed. And also for the JP Morgan, the Citi, and the Bank of America, the consumer part of it, and how their charge-offs are doing, and what their read is on the consumer. As Francis Donald was talking about, just two totally different worlds for two totally different consumers.
Yep, absolutely. So we will see JP Morgan reporting on Friday, so that'll be...
You're off, though.
I'm off. You're darn right I'm off.
He's not going to care till Monday.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.